Hello friends, welcome to our channel. Today we are going to talk about one of the most important topics in mutual fund investing. Should you build your portfolio only with index funds? Or should you combine index funds with active mutual funds for better returns and balance? This is a question almost every beginner investor faces, especially when starting SIP investing or planning long-term wealth creation. Let's understand this step by step in a very clear and practical way. First, understand one simple truth. In investing, there is no single perfect strategy for everyone. The best investment strategy depends on your financial goals, income stability, risk tolerance, investment horizon, and personal understanding of the stock market. Now let's understand index funds in detail. Index funds are passive investment funds that simply track a market index like Nifty 50 or Sensex. This means they do not try to beat the market. Instead, they aim to match the market performance. The biggest advantages of index funds are low expense ratio, simple structure, low risk of fund manager error, and long-term stability. That is why index fund investing is widely recommended for beginners, salaried individuals, and long-term SIP investors. Index funds are powerful because they follow the principle of long-term compounding. When you stay invested for 10, 15, or 20 years, even small SIP amounts can grow into a large wealth corpus due to compounding returns and disciplined investing. Now let's understand active mutual funds. Active funds are managed by professional fund managers who actively select stocks, analyze companies, and try to beat the market benchmark. The goal of active fund investing is to generate alpha, which means higher returns than the index. Active funds can perform very well in certain market cycles, especially when fund managers take correct decisions in stock selection, sector allocation, and timing. However, performance is not guaranteed and depends heavily on fund manager skill, market conditions, and fund strategy. Now the important question, which is better? The truth is, both index funds and active funds have their own advantages. There is no need to create a conflict between them. A smart investor does not choose emotion, ego, or trends. A smart investor focuses on financial planning and asset allocation. Let's talk about a smart investment strategy. For beginners, index funds should be the foundation of your portfolio. They give you market exposure, stability, and long-term growth without much complexity. This is ideal for SIP investing, especially if you are building wealth from scratch. Once you gain experience and better understanding of mutual fund performance, you can add a small portion of active funds to your portfolio. This creates a balanced investment portfolio where index funds provide stability and active funds provide growth opportunities. This approach is called core and satellite investing strategy. The core is your index funds, and the satellite portion is your selected active funds. Now let's talk about one of the most important concepts in investing, which is risk management. Every investor must understand their risk appetite. If you are someone who prefers stability and predictable returns, index funds are more suitable. If you are willing to take slightly higher risk for potentially higher returns, you can include active funds. Another important factor is diversification in mutual funds. Many investors make the mistake of buying too many funds without understanding overlap. A good portfolio is not about quantity, it is about quality and balance. Also remember, the biggest mistake in investing is emotional decision-making. Investing based on fear, greed, or social media trends often leads to poor financial results. Successful investors always follow discipline, patience, and long-term thinking. SIP investing plays a key role here. Whether you choose index funds or active funds, systematic investment plans help you invest regularly, reduce market timing risk, and build wealth consistently over time. Over a long period, power of compounding becomes the biggest wealth creation tool. Even a small monthly SIP can grow into a large corpus if you stay invested for 15 to 25 years without interruption. So the final conclusion is simple. There is no need to choose one side. Index funds and active funds are not competitors. They are tools that serve different purposes in your investment journey. A beginner should start with index funds. An experienced investor can add active funds for additional growth potential. But in every case, the focus should always be long-term wealth creation, disciplined SIP investing, and proper financial planning. If you follow this approach, you can build a strong investment portfolio that supports your financial freedom in the future. If you found this video helpful, please like, share, and subscribe to our channel.